On this episode, number 112, you will learn the next quarterly tax payment and how it works. So we're going to dive into what are quarterly tax payments, why do you need to pay them, like what are the consequences if you do not, and how much does the IRS want you to pay each quarter. As always, if this episode helped you or brings you value, please do us a favor and share it with a friend. Thank you and enjoy the show. Welcome to Build Your Wealth Muscle, a podcast dedicated to helping fitness entrepreneurs build wealth by saving taxes and growing their money. Each episode will break down different strategies in the areas of business, tax, and retirement planning specifically for your coaching business. Disclaimer, the topics covered in this podcast are for educational purposes only. This is not advice for your specific situation. Please consult a qualified financial or tax professional before making any changes to your financial or tax situation. Now here's your host, certified financial planner and tax advisor, Pat Darby. How's it going, everybody? Welcome back to Build Your Wealth Muscle. This is episode 112. So if you're a first-time listener, again, last week we kind of brought the podcast back from the dead. So if you're first time listening, there's basically two show formats. A solo episode like today, where we're going to go into in-depth of the topics of conversation, specifically today, quarterly tax payments. And then other times we'll bring on a guest and they'll be an expert in some field of either legal, marketing, sales, or maybe even just like essentially a colleague of yours running a online business as well. So today we're going to dive specifically into the quarterly tax payments. I've done an episode on this a few times. For a couple of reasons. One, it's important because it comes up 4 or 5 times a year, but there also seems to be some confusion around it. So I want to do my best to go into that. And I also have a screen share. So for anybody listening on a video, you'll have a visual as well. So let's take a step back on why, as entrepreneurs, we pay the quarterly taxes. In general, you're probably potentially listening to this because you're a business owner. One of the hard parts of business ownership are the sneaky side of taxes, especially like the self-employment side. It can really sneak up on a new business owner who didn't necessarily make that much money in their opinion, but their tax liability could be pretty high. And on top of that tax liability could be some penalties from the IRS for not paying on time. And so you might think to yourself, well, I paid on April 15th. I thought that's when you have to do your taxes. Why am I getting assessed a penalty? And the reason for that is because the IRS wants their money throughout the course of the year. Now, you're typically doing this by default when you have like a W-2 job. Someone's cutting you a paycheck and that withholding that you lose out on your paycheck, that's being sent to the IRS every 2 weeks or every month or however your pay frequency is. As an entrepreneur, no one's doing this for you. So you have to each quarter send the IRS their money. And so they'll say, okay, those 4 payments means that we're good to go. And so the main reason for that, again, is to avoid underpayment penalties. So we'll get into later on what it costs if you fail to do this. And I will caveat by saying some people purposely don't do this. And that's a more advanced situation if like the cost value of like the time value of money and the cost of money. So let's first start with some of the basics. When are the payments due? The payments are due in April, June, September, and January. So as I'm recording this, we're in early January of 2026. January 15th, 2026 is the Q4. It's the final 4th payment for 2025. So each year, the January payment is the 4th quarter of the prior year. So just so you know, it's the 15th of each month of those months, April 15th, June 15th, September 15th, and January 15th. That will only vary if the 15th is a Saturday or a Sunday or a federal holiday. It'll be the later date. It won't be before it. So now let me sort of back up. So we've established you need to make those 4 payments. But let me dive into the cash flow side of things just so it doesn't get confusing. Is not the right word. Maybe overwhelming. April 15th is arguably one of the worst days for a self-employed business owner because 2 things are due at the same time. So I just explained that there's 4 payments. Again, just so I'm going to repeat myself a lot during this because I want this to be simplified for how many times I've had conversations with clients where like this process, specifically the the April timeframe can be very overwhelming if they don't fully understand it and or if they're not prepared for it. So if you're listening to this in January, you have 3 more months to get prepared for what could also be an overwhelming situation for you. So you have those 4 payments. Again, April 15th is the first payment for 2026 for Q1 of 2026. But that's also the final balance due payment for 2025. So I'm going to go through a hypothetical example at the end, and you'll see like how you could have your quarterly payments and a balance due. And I'll explain all that. But just so I'll leave it at this point, April has potentially two tax payments. Definitely it has Q1 of 2026, but if you have a balance due from your 4 quarterly payments and you still owe a little bit more, that's also due on that same day. So again, that can be a very overwhelming day, especially if you have a very successful business and maybe the tax side of things, you don't necessarily have the cash laying around like you would like. All right. So the other area that you could do if you're an S Corp owner that counts towards this is your withholding. So if you have your payroll, maybe you increase your withholding from your payroll, and that also is a way to help satisfy your quarterly payments. It's up to you how you want to do it. If you want to do a little higher each month through your payroll, or you like the quarterly payments. One of my opinions on it that I like the quarterly payment is just, again, with each passing quarter, this may not be accurate anymore, but when interest rates in savings accounts are over 4%, I would much rather keep that money saved on my end, earn some interest on it, then pay it out to the IRS, because when I pay it out to them, I don't get anything from that other than owing them their taxes. So that little bit of arbitrage, again, since I am also a certified financial planner, I love the little compound interest wherever I can get it. But that may be of interest to you as well, listening, saying, yeah, like if I'm going to pay them $30,000 every quarter, I'd rather that $30,000 sit for 90 days inside of a savings account, making me 3%, 4%. It was, a little bit more than that a year ago. But if you say conversely, I'd just rather get this headache off my plate, I totally get that too. Okay, so right now, let me go back to what we were saying before. As of I'm recording this, January 2026, the interest on the penalty is about 7% that the IRS is going to charge you. In general, even though you don't want to owe money to the IRS, they're not the most expensive lender. Meaning if you get behind on them and you're on a payment plan or you get hit with these late penalties, again, they're going to charge you, right as I'm recording this, 7%. So if you're comparing that to paying on time and making 0 and paying them 0 and maybe getting a little bit of 3%, 4% in your savings account, then that's great. But if you're in a situation where maybe you're worried about taking out a line of credit or putting something on a credit card and that credit card balance is going to hit you at 25%, maybe getting behind and waiting till April to pay the IRS isn't the end of the world. Because if you're comparing 7% to 25%, again, if you're using like a credit card. But I don't say that to say you should purposely do it, because you do need to have the money in April. Because when you get to April, you can extend the paperwork. So if you were normally going to file everything in April, you can extend it out to October. However, there's no such thing as an extension on the payment. So it is officially late if you don't have the payment in on April 15th, even if you said, I'm going to file my taxes on October 15th. So if you're going to do a strategy, or if you have a type of business where you, for whatever reason, really need the cash and you're rather owe the IRS 7% than a credit card 25%, I understand that. And again, I would want you to walk that strategy through, make sure you know your cash flows. But that would be something that somebody might do if they realize it would be more expensive the other way around. But again, you still need to have the money in April. So again, to reiterate, April 15th can get very expensive. And this is now I'm going to go into how you calculate it, and you'll see why you could have your payments that you make on a quarterly basis and a balance due. So the IRS has, and now let me share my screen. I hope this is my first time using the screen share function, so I hope it works out well for everybody. Okay. So if this is properly shared, and I hope I did it properly, you can see on here that I plugged in. So basically, let me back up and try to explain it. So your quarterly estimate is a calculation. So all tax software, when you file 2024, all tax software spits out a number and it says, this is how much you owe in quarterlies next year. And it's based on line 24 of your tax form 1040. So it's on page 2 of 1040, and it just shows the total tax you paid. And so the IRS says, okay, so you paid $100,000. You can just divide that by 4. So I'm going to change this number to 100% just to show you. And then it would just say, all right, you owe $25,000 every quarter. So you can see on this calculation, it just does the math and says 25,000. The reason most software that you're going to see is going to have it at 110% is because that is the safe harbor rule. If you make over $150,000, then it kicks it to 110%. So that can sound confusing, but just that's the way that they're pulling the number from, saying, because the IRS just wants to get paid 100% or 110% of what you made last year. Now, you could also pay less if your business is doing worse. So you can take the lesser of the numbers, because you could also pay 90% of your current tax liability. So in this hypothetical scenario, you paid $100,000 last year. And then let's just say, for argument's sake, your business is doing worse and you would only owe in that scenario $90,000, 90% of your current year tax liability. Well, let's say we're going to owe $100,000 again. You could just pay 90. So I'm just trying to do the math quickly in my head, but that's the other way to look at it. If you are having a much worse year in 2025 than you did in 2024, then you can pay 90% of the current tax liability. But if your business is doing the same or better, you're using this formula here at 110%. And so that's what your accountant is going to do for you. Like their software, I should say. So the reason I said you could have a balance due is because let's walk through this scenario. So again, taxpayer in 2024 had $100,000 tax liability. So the software is just going to say, all right, you're 110% here. That's 110,000. You just divide that evenly by 4, and it's going to be 27,500 every quarter. And so in this section, I'm saying, okay, because if you're working with a tax advisor, they're going to say, well, what is your actual current tax liability? Because there's two there's two strategies that are running simultaneously. It's this column where we're trying to minimize or eliminate completely any underpayment penalties. Then on this side, we're sort of trying to cash flow plan for what you actually will owe, just so you know it. Because as a hypothetical scenario, we're saying, all right, last year you owed 100, your business is doing much better. Now you're going to end up owing 150. So if we go through and we're like, hey, we recommend the IRS is going to want at least 27,500 every quarter. We're recommending you pay 30. Again, you can stick with 27.5 if you wanted to, but you just want to have a tracker internally where you're saying, all right, I'm on pace to owe 150. I'm going to owe 150. I'm on pace to have paid 120. So in April, I'm going to have 30. Now, using that same math, let's just say the following year, because that upcoming April, we're saying now you're at 150. You can see that your quarterly payment for April jumps to 41. So that from a cash flow perspective, you need to say to yourself, okay, I've been told by my tax advisor that for 2025, I'm going to owe 150,000. And because of the quarterly payments that he's been recommending to me, or she's been recommending to me, I'll have a balance due of 30,000, and I won't have any underpayment penalties because I made the quarterly payments, but I'll still owe 30 grand. And based on this number, the IRS runs the calculation again for Q1 of 2026. And now this number, 41.2, becomes your new quarterly estimate for all 4 years of each quarter of 2026. So now you add these two numbers up and you talk from a cash flow perspective, in January that, hey, I'm going to owe $70,000 in payments in April. Again, this number is going to vary for everybody on how big your business profits are, but that's what happens in April that really messes people up, is because they're just getting by to pay off their 2025 liability. And then the IRS is sitting there on April 15th saying, okay, where's Q1 of 2026? And if you had a very good year, they're already upping what you owe them to avoid the penalties. Just so you're aware that in this, I have it zeroed out on the actual spreadsheet just to make life simple. But if you're an S corporation, you're going to be running payroll. And so in theory, maybe you've already done 30,000 through withholdings inside of your S corp wages, and now you don't owe anything. Because like your tax advisor is going to add these two numbers together, like what you've paid so far and what you've withheld so far, to see what your total balance due is. So I hope that's helpful, because so let me kind of run through it again. Because if your business is growing, you're going to take this 100,000. Let me go back to it. Or maybe I can even try to use smaller numbers just to give you guys other examples. So if you owed 40,000, again, you take 110%, and it's going to say your minimum due each time is 11. So let's just say we're recommending only 11, and let's say you paid 11. Or no, I'll just keep it simple. And just so we can see how the math will work out. So you can see in this scenario, again, we pegged everything to this number of 40,000. And since that comes to 44 divided by 4, $11,000 per quarter. Again, this is to avoid underpayment penalties. So in this scenario, you're on pace to owe 100,000, but we're going off of 2024 when you only owed 40. So you can see this gets a little more expensive when you're going to roll into January and when you roll into April, this 56,000 is still due on April 15th, even if you extend it. And so that's going to get a little bit expensive, because you say, all right, I paid in 44, I'm going to owe 100. And then when you get right back to it, what is it for the next year? Boom. So now you owe this number and this number. So the 56,000, so sorry for the audio only people, we just moved it to 56,000 or 27.5 plus the 27.5, because you just had a good year and the IRS quote unquote rewards you with a higher payment for the upcoming year. So that's where those numbers come from. Now, let me just kind of give you a recommendation. Feel free to do it or not do it. I highly recommend when you're making your payments, you use this trick. Sorry, I'm doing it live. So anyone on audio only, I'll go back and explain it. So if you owed 11,000 per quarter, I highly recommend you make your Q1 payment 11,001 and Q2 payment 11,002, 11,003. And the reason for that is because, again, the software will just divide it by 5. The software will just divide everything by 4 into simple numbers. The problem you're going to run into is the federal government, the state, sometimes a payment just gets lost for whatever reason. Maybe they applied it to your business tax ID number instead of your social. Maybe they just didn't process it. Maybe something happened and they kicked it back to you. But what's hard is that when you log into the portal, if you see 3 payments of $11,000 and the timing doesn't always line up with when you sent the payment, you don't necessarily know which payment got rejected or is lost. But then if you get a refund in the mail for like $11,002, or you see $11,002 is the only one missing, you immediately know something happened in Q2 and they lost your payment or got returned to you for whatever reason. So I highly recommend that just little tip to just label the back number. You don't have to do that for the 5th payment usually, because the last payment is usually going to be like a very specific number. So you're going to run it, whether you file in April or you make your an extension payment when this balance is due, but it could easily end up being like $56,205 or something very specific. So you don't necessarily have to label that one, because again, it will stand out. Whereas the others could end up being round numbers that all look like each other. So the overarching theme here is, if you're having a good year compared to the prior year, this is how you're going to have to run your payments. And so playing the game of, on one hand, saying, all right, I want to keep up with the payment so I don't owe any underpayment penalties. And then the other side of it, making sure you're following the cash flow. Because again, just to reiterate, it would be very troublesome if you are going through, let me put these numbers back to 100,000. And so I'll just make these 28,000. So for those on audio only, I'm going back to the $100,000 scenario that we started with so that all the numbers are the same. And I'm going to say you owed 150. So that will have it that you paid in. If we paid just above, so I changed the scenario a little bit in that before we were paying $30,000. This time we're paying $28,000. And the reason for that would be the type of client who says, well, no, I want to only pay what I have to pay, so the rest will sit in my savings account. But in that scenario, you want to make sure the $150 you owe versus the $112 you paid, that you have that $38,000 sitting in your savings account, accruing interest, waiting for the IRS on April 15th. And then conversely, if you're going to owe $150, then same thing from a cash flow perspective, you have another $42,000 sitting in there, $41,250 in it from a cash flow. So again, this is a topic not just about how to make your payments and why to make your payments, but also helping you watch your cash flows. So let me see. The last thing that I'll cover here is just where do you pay? You go to the irs.gov website. You can log into your account, direct deposit it, or your tax advisor can potentially auto debit it for you. On the state side, if you live in a state that has income tax, you're going to that will become a little bit trickier. So here's something that we should probably dive into for only a minute, because this can be its own topic. Let me stop sharing. So when you pay a federal tax payment, it is not deductible to your business. It's a personal expense, essentially, even if you pay it through your business bank account. Conversely, I think there's like 35 states that let you deduct the state tax payment that you make. So that payment should be made through the business, but you need to do it the right way. And each state has its own procedures and deadlines. So I don't want to give you specific guidance on the state level other than check with your state or your advisor, because there is a tax loophole where you can write off your state income tax, your personal state income tax, as a business expense. But you have to do it the right way, or otherwise the state won't count it. So I'll just leave that one as like a to-do item for you to check with your accountant or tax advisor. But that's everything I wanted to go over on my end. Again, as I'm recording this, the next tax payment coming up is January 15th, 2026. And that is, again, Q4 of 2025. But if I'll just say for the third or fourth time, just be very careful with the fact that a balance due payment is still coming on the 15th of April. Even if your accounting software that your accountant gave you, maybe not working with advisors, you just get you pay your taxes and they say, hey, here's your 4 payments, and they're on autopilot. So you think you're okay. But if your business generates a higher tax liability, there will be a balance due in April. And that will coincide with Q1 of 2026. As always, thank you guys for listening. If this was helpful, please share it. I should probably make a funnel or something to send out this spreadsheet. If you need this spreadsheet, DM me at the Pat Darby on Instagram and TikTok. But I don't even know how DMs work on TikTok, so don't DM me on Instagram. Or you can email it in to info@sincitycfo.com and ask for it. But as always, guys, hope you have a great week and have a great day. Thank you for joining us this week on Build Your Wealth Muscle. The links mentioned in this episode are available in the show notes. For video clips and more information on tax and retirement strategies for fitness entrepreneurs, please follow my Instagram at the Pat Darby. If you found value in this episode, please do us a favor and share with a friend. If you tag me, that'd be appreciated also. Lastly, for help implementing any of the topics discussed, please book a call. The link is also in the show notes. Thank you again for listening, and have a great day.